$130 per ounce. That's what physical silver cost in Tokyo on January 2nd, 2026. Not in some black market deal, not through an offshore premium scheme, at legitimate bullion dealers when they could find inventory at all. The same day, COMEX futures in New York quoted $72, an 80% premium, the largest price divergence in the history of precious metals trading. Gold occasionally sees 5 to 10% premiums during supply crunches. Silver sometimes trades at modest regional differences, but an 80% systematic decoupling between paper contracts and physical metal across an entire hemisphere, that's not market volatility, that's market structure failure. The official explanation from exchanges and bullion banks, regional supply chain issues, temporary logistics delays, year-end settlement pressures, nothing systemic. Move along. But here's what they didn't mention in those carefully worded statements. On December 29th, the Federal Reserve's overnight repo facility jumped from near zero to $26 billion. Banks borrowed this emergency liquidity in a single day. The third highest level since the standing repo facility began operations in 2021, only surpassed by the October 31st spike that hit $50 billion. 3 days earlier, on December 26th, an unnamed institution had accessed $17 billion in emergency Fed lending. The day after Christmas. The identity of that borrower remains classified under Federal Reserve disclosure rules for 2 years. Someone needed that much emergency funding when markets were supposedly calm, and we won't know who until 2028. Connect the timeline. Physical silver hits $130 in Asia, while paper trades at $72 in New York. An unnamed bank needs $17 billion in emergency cash. 3 days later, the entire banking system taps $26 billion in overnight repo, all within a week of China implementing the most restrictive silver export controls since rare earth restrictions. This isn't coincidence. This is convergence. The story actually starts months earlier in a way most people missed. Throughout 2025, something unusual was happening in precious metals markets. Silver lease rates, which normally hover around 0.3 to 0.5%, suddenly spiked to 7%. Then, in October, they exploded to 200% overnight when India placed an order for 1,000 tons. 1,000 tons. The London Bullion Market Association reported 844 million ounces in their vaults at the time. That's 23,900 tons. The market should have easily absorbed a 1,000-ton order without breaking stride. Instead, it froze completely. Swiss refiner Metalor, which operates in 17 countries, announced they would not return to the market until January 2026. All traders withdrew. The lease rate spike signaled something fundamental. The metal wasn't where the vault report said it was, or it was pledged in ways that made it unavailable, or both. But that was just the preview. The Federal Reserve's December actions need to be understood in full context. Since December 1st, 2025, the Fed officially ended quantitative tightening, the program designed to shrink the balance sheet by $95 billion per month, dead. They stopped after reducing holdings by just $1.4 trillion of the original target. The timing matters. By early December, something was breaking in Treasury markets. SOFR rates, which track overnight lending costs between banks, showed stress signals, not crisis levels yet, but enough to trigger Fed intervention. On December 11th, the Fed made a quiet but massive change to their standing repo facility. They removed the $500 billion cap entirely. The official language called it Operational Flexibility Enhancement. The translation? Unlimited emergency lending with no ceiling. They even renamed the facility to reduce what internal memos called stigma, the fear banks have of being seen accessing emergency funds. Think about that sequence. December 1st, QT ends. December 11th, emergency lending cap removed. December 26th, mystery borrower needs $17 billion. December 29th, entire system taps $26 billion. Each step was presented as routine, year-end housekeeping, liquidity management, standard operations. But standard operations don't require removing lending caps 3 weeks before year-end. Standard operations don't involve $17 billion emergency loans on Christmas weekend. This was preparation for something specific. Now, examine what was happening simultaneously in physical silver markets. The divergence between paper and physical didn't appear overnight. It built gradually through December, then accelerated dramatically as January 1st approached. In Shanghai, physical silver premiums climbed from $3 per ounce to $8 above COMEX prices throughout late December. Buyers in China offered suppliers $8 premiums to secure metal. Indian buyers offered $5. These weren't small retail premiums. These were institutional buyers paying significant amounts above benchmark pricing to guarantee delivery. In Dubai, PAMP Swiss bars were listed at 470.83 UAE dirhams. At the exchange rate of 0.272, that equals $128.2 per ounce. In Japan, dealers who still had inventory were quoting $130 for immediate delivery. Meanwhile, COMEX futures sat at $72. Western ETFs still priced holdings at paper rates. The entire derivatives market continued pricing as if nothing had changed. This is what market failure looks like in real time. Not a dramatic crash, not an exchange closure announcement, just a quiet, growing gap between what screens show and what physical metal actually costs. The mechanics of this divergence reveal the deeper problem. For decades, silver pricing has been discovered through futures markets. COMEX in New York and LBMA in London set the global benchmark. Physical transactions referenced these paper prices, adding or subtracting modest premiums based on local conditions. This system worked when the ratio between paper contracts and physical metal stayed within reasonable bounds. Industry estimates suggest that ratio reached 300 to 1, 300 paper claims for every physical ounce. As long as most contracts settled in cash and only a small percentage demanded delivery, the system functioned. But when physical demand accelerates while supplies tighten, that ratio becomes toxic. Every entity holding paper suddenly realizes they might not be able to convert to physical at stated prices. The scramble begins, and paper prices stop reflecting reality. The December COMEX delivery data tells this story in stark terms. Registered silver inventory available for delivery has collapsed 70% since 2020, from over 200 million ounces to 127 million ounces as of January 7, 2026. That 127 million ounces represents the entire pool of metal available to satisfy delivery demands on COMEX. For context, December 2025 saw delivery requests approaching 65 million ounces, nearly half the entire registered inventory demanded in a single month. The exchange managed to fulfill those deliveries barely. Metal was transferred between vaults, converted from eligible to registered status, and moved through the system. But the strain was visible in the data. Open interest remained unusually high compared to available physical stocks. Backwardation appeared, spot prices trading above futures. The classic signal of immediate physical scarcity. Then came January. On January 7, 2026, CME COMEX delivery reports showed something remarkable. Holders of 1,624 January contracts received delivery of 8.1 million ounces. This was unusual for several reasons. January is a minor delivery month. Most futures trading focuses on March, May, July, September, and December contracts. January typically sees minimal delivery activity. 8.1 million ounces in a single day for a minor month contract? That's not normal hedging behavior. That's physical accumulation. But the most revealing detail was who issued that delivery. JPMorgan delivered 99%, 8 million ounces from a single bank's vaults, distributed to numerous stoppers, the technical term for entities taking physical delivery. JPMorgan's role in this deserves careful examination. For years, the bank faced accusations of silver market manipulation. In 2020, they paid nearly $1 billion to settle Justice Department charges of spoofing and manipulation in precious metals markets. The settlement covered 8 years of illegal trading activity. Throughout that period, JPMorgan maintained massive short positions in silver futures while simultaneously accumulating enormous physical stockpiles. Critics called it the trade of the century, suppressed paper prices through futures manipulation while buying physical metal at artificially low prices. When the manipulation ends, hold the physical as prices correct. The recent delivery data suggests that playbook reached its final chapter. JPMorgan appears to have flipped from net short to aggressively net long. The January 7th delivery, where they issued 99%, could indicate their positioning for what comes next. Distributing metal to clients, covering any remaining obligations, and preparing for the repricing. But that's speculation based on public data. What's not speculation is the math. If December deliveries approached 65 million ounces, and January is already seeing accelerated delivery demand despite being a minor month, the 127 million ounce registered inventory won't last long at these burn rates. 3 months of elevated delivery demand would drain it completely, and that calculation doesn't account for what happens when the Asian premium becomes widely known. When industrial users realize they might need to pay Tokyo prices rather than COMEX prices to secure supply. When investment demand surges as the paper system's fragility becomes obvious. The convergence point approaches rapidly. China's January 1st export restrictions transformed this situation from critical to acute. The new policy requires exporters to obtain government licenses with minimum annual production requirements of 80 tons. The timing wasn't coincidental. China watched the October London market freeze. They observed the December COMEX delivery surge. They recognized Western markets were already stressed. Then they moved to secure domestic supply, while Western competitors scrambled. China's Ministry of Commerce framed this as environmental protection and resource management. The reality is more strategic. Silver's role in semiconductors, AI hardware, solar panels, and electric vehicles makes it critical to China's industrial policy. By restricting exports, they ensure domestic manufacturers have priority access, while Western competitors face supply uncertainty. The geopolitical implications extend beyond industrial policy. This is commodity weaponization, similar to rare earth restrictions China implemented previously. When one nation controls 65% of a critical material supply and implements export restrictions, they gain leverage over countries dependent on that material. The United States, Europe, and Japan now face a coordinated supply squeeze. Physical silver from China requires government approval. London's market showed dysfunction months ago. COMEX registered inventory drops toward critical levels. And prices in Asia already reflect the new reality, while Western paper markets lag. Industrial users face impossible choices: pay 80% premiums for physical metal or hope paper contracts remain convertible at stated prices. Lock in multi-year supply at elevated costs, or risk being priced out entirely if the paper system fails. The solar industry alone requires over 100 million ounces annually. Electric vehicle production needs another 60 million. Semiconductor manufacturing is inelastic, meaning producers will pay whatever necessary to maintain output. These aren't discretionary uses where demand drops when prices rise. These are embedded industrial requirements. Add investment demand to industrial consumption, and the deficit becomes structural. The Silver Institute projects 2026 deficits between 95 and 200 million ounces, the sixth consecutive year of supply shortage. Mine production can't scale quickly enough to fill the gap. Recycling provides some supply, but not nearly enough to cover the shortfall. In this environment, the paper price at $72 becomes increasingly meaningless. It represents derivatives market pricing backed by fractional reserves. The physical price at $130 represents actual supply-demand clearing in markets where delivery must occur. Eventually, those prices converge. Either paper rises to physical levels or the paper system breaks through force majeure declarations when exchanges cannot deliver. The December Fed liquidity injections and unnamed bank bailout suggest market makers understand this dynamic. Someone with significant short exposure needed emergency funding when physical premiums exploded. The Bloomberg Commodity Index rebalancing adds another layer of pressure. Starting January 8th, passive funds began selling approximately $6 billion of silver futures to rebalance portfolios. Silver's weight dropped from 8.19% to 3.94% in the Bloomberg Index. Goldman Sachs Index cut silver from 1.23% to 0.65%. $6 billion in systematic selling pressure over 5 trading sessions. Under normal circumstances, this would drive prices down significantly. But these aren't normal circumstances. This selling is paper contracts, not physical metal. And the physical market is already in severe backwardation, signaling immediate delivery demand exceeds supply. The rebalancing created a temporary price dip from the December high near $84 down to mid-70s by January 9th. The question is whether that dip represents opportunity or risk. If the paper system maintains credibility, buying the dip makes sense. If physical delivery capacity becomes questioned, paper positions become liability rather than asset. Smart money appears to be choosing physical. The delivery demands, the Asian premiums, the vault inventory, drawdowns, all point toward institutions securing actual metal rather than trusting derivatives. This isn't retail investors buying coins. This is size money making strategic allocation decisions. As of these dynamics, the $26 billion repo spike wasn't about seasonal year-end liquidity needs. Year-end spikes are predictable and usually smaller. This was the third largest access of the standing repo facility since inception. Banks don't tap emergency funding at those levels for routine operations. The unnamed $17 billion borrower adds intrigue. Federal Reserve disclosure rules keep that identity classified for 2 years. By the time we learn which institution needed emergency funding on December 26th, the silver situation will have resolved one way or another. Either paper and physical prices converged, or the paper system experienced a failure event. Consider the possibilities. If a major bullion bank holds short positions they cannot deliver against, and physical prices spike 80% above paper, their exposure becomes existential. Mark-to-market losses on derivatives books could easily reach billions. Margin calls would cascade. Counterparty risk would spread through the system. The Fed's response would be exactly what we saw. Emergency lending to prevent disorderly failure. Removal of facility caps to enable unlimited support. And public messaging that everything is routine while privately managing crisis. This pattern repeats throughout financial history. Authorities never announce crisis in real time. They announce crisis after it's contained. The March 2023 Silicon Valley Bank failure followed this script perfectly. The banking system is sound right up until the weekend intervention. Then retroactive explanations of what actually happened. The silver situation could be following the same playbook. Public assurances of routine operations while privately managing a bullion bank's massive short exposure gone wrong. Emergency liquidity to prevent immediate failure. Time bought to orchestrate an orderly unwind. and hope that physical delivery demands don't overwhelm the system before positions can be covered. But time is the one resource running short. China's export restrictions took effect January 1st. The Bloomberg rebalancing started January 8th. COMEX registered inventory sits at 127 million ounces with elevated delivery demand. Tokyo dealers quote $130. Shanghai trades $8 above COMEX. Dubai confirms $128. The physical market has already repriced. The paper market hasn't acknowledged it yet. That gap will close. The only question is how. If paper prices rise to meet physical, holders of futures contracts profit enormously. 72 to 130 represents 80% gains. Leveraged futures positions could generate returns of several 100%. This is the bull case. Paper catches up to physical reality through normal price discovery. If the paper system breaks through force majeure or exchange settlement failure, the outcome becomes chaotic. Cash settlement at artificial prices, legal battles over contract terms, loss of confidence in derivatives markets, and a repricing of physical metal far above current levels as the fractional reserve system collapses. The semiconductor industry illustrates this perfectly. Chip manufacturers require specific silver specifications delivered to exact locations on precise schedules. They cannot substitute alternatives. They cannot delay production. They must have the metal regardless of price. When physical premiums hit 80%, semiconductor companies either pay or shut down production. Given the strategic importance and profitability of chip manufacturing, they'll pay. But those costs flow through to electronics, automotive, defense, and technology sectors. Inflation in a critical input material ripples across entire economies. Elon Musk's December 28th comment on X captured this concern. Responding to posts about China's export restrictions, he wrote, "This is not good. Silver is needed in many industrial processes." The understatement was deliberate. Musk runs companies deeply dependent on silver. Tesla electric vehicles, Starlink satellites, SpaceX systems all require substantial silver content. The weight of this situation extends beyond silver markets. This represents the first major failure of a paper-based pricing mechanism for a critical industrial commodity in the modern era. If silver's fractional reserve system breaks, the precedent carries implications for gold, platinum, palladium, and potentially other commodity markets. For now, the data points in one direction. Physical metal is scarce. Paper claims are abundant. The price gap reflects that imbalance. And authorities are providing emergency liquidity to prevent disorderly resolution. The math is unforgiving. Industrial consumption continues regardless of inventory levels. Chinese exports are now restricted. London's market already showed dysfunction. COMEX registered inventory has fallen 70% since 2020. And physical premiums in Asia prove the metal isn't where paper markets claim. This story doesn't have a neat conclusion yet. The situation remains fluid. Banks have emergency Fed liquidity. Exchanges have circuit breakers and rule mechanisms to manage extreme volatility. Authorities have tools to prevent immediate systemic failure. But tools to prevent immediate failure aren't the same as solutions to structural problems. Silver's supply deficit is real. China's export restrictions are real. Industrial demand growth is real. COMEX inventory depletion is real. And the 80% premium between Tokyo and New York is real. Something has to give. Either paper prices rise dramatically to match physical, or physical delivery obligations get settled through cash or force majeure. Either outcome represents a fundamental break from how these markets have operated for 50 years. The unnamed bank that needed $17 billion on December 26th knows this. The institutions that tapped $26 billion in Repo on December 29th know this. The question is when market participants broadly recognize what's already visible in the data. $130 in Tokyo, $72 on COMEX, the biggest decoupling in precious metals history, and $26 billion in emergency Fed liquidity the same week China's export restrictions began. This isn't over. This is just starting.